If you were a 2 or 3 fund portfolio kind of person, ETF selection might not really be a problem for you. However, if you're the type to become a little bit more adventurous, this can quickly become quite challenging. In the world today, there's roughly 7,000 plus ETFs as of 2020, and in the US alone, there's about 2,000 plus. And even if you decided to choose amongst the top 10 out of the 300 plus ETF providers, that's a universe of about 1,200 plus ETFs, and there are more coming each year. That's why in today's video, I'll be talking about what to look for in ETFs generally, and then in very specific scenarios, what else do you need to pay attention to? Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. So let's start with what you generally need to look out for when evaluating any ETF. So even if you're new to this, odds are you likely heard of the expense ratio. This is essentially the annual fee that you are paying to own this ETF, and it's pretty much the operating expenses of the fund. This information can usually be easily found in any website or comparison tool, or if not, you can find it in the prospectus. And fun fact, you are not actually paying a physical bill. This ETF expense ratio is automatically deducted from the value of the fund itself, so you won't see it as a literal expense. Now, I shouldn't need to tell you why keeping your expenses low is important, but it is. And even though those numbers look really small, it really adds up over the long term. The great news is for us individual investors is that fees are continuing to drop over time. Right now, you can expect an actively managed ETF, like one of those ARK funds, they will charge you roughly 0.75% per annum. Or that's $75 to manage $10,000 in a year. Really large and popular index-based ETFs, on the other hand, can be really cheap, up to as low as 0.02%. That's $2 to manage $10,000 in a year. And the vast majority of ETFs will fall within that range of 0.02 or 0.75. The next thing to pay attention to is the spread prices between the bid and ask price. Now this factor is more important for those of you who are holding shorter term or maybe even trying to trade an ETF. And even for long-term holders, it's always good practice to be very alert to these bid-ask prices. And hey, who doesn't want to get a good price to buy a product, right? If you're trading in very liquid ETFs in the US, they can be as low as 1 cent. Next is assets under management, or AUM, which is basically the amount invested within that ETF. The general rule of thumb is that anything above 50 million should be something that's fine. The benefit of large AUMs is that they tend to be able to drive costs lower because of efficiencies, and on top of that, the bid-ask prices tend to be narrower. And fun fact, in 2020, there were nearly 300 plus ETFs that were shut down globally because they couldn't gather enough investments within it to be profitable. Because remember, the less money that's within that ETF, the less money that the managers actually make. And in case if you were worried or wondering about what happens if your ETF gets shut down, don't worry so much. Usually they'll provide some kind of forewarning that something is going to happen, so you'll be able to sell that ETF ahead of time. And in a worst case scenario, if you were holding on to an ETF that was liquidated, the money that was gathered from it will be returned to you anyway. Now let's look up to specific scenarios in where you're comparing between ETFs. The first question could be, do different ETF providers really matter? There are hundreds of ETF providers out there, and I'd say that if you were sticking to the top 5 or 10 ETF providers, you really can't go wrong. They are safe, reliable, and usually the costs are very competitive as well. The only reason why you want to venture beyond the top 10 is that you want to look for specialists in what they do. For example, ARK Invest is one of those ETFs which I invest in, and they specialize in disruptive innovation. Global X is another kind of ETF provider which specializes in thematic investing. And you have players like Dimensional Holdings, which are specialists in the unit trust or mutual fund space, but they have recently launched its own suite of ETFs and they follow a very specific methodology. Next, as you begin evaluating between ETFs, you might be seeing some weird acronyms pop up in the name. So you're wondering, what are those weird letters? They could be MSCI, FTSE, S&P, CRSP. So these are just some of the acronyms that you might see pop up within the name. And these acronyms usually refer to the index provider. And if you didn't already know, the majority of ETFs that you invest in will likely be tracking an underlying index. Now this might be news to you, but it is perfectly normal to have an ETF provider and the underlying index being completely different companies. Think of the ETF provider as some kind of manufacturer, and they're building an ETF that's based off the specifications of the index provider. Now this really matters when you are beginning to compare ETFs to accomplish a specific goal. So for example, say you wanted to invest in the emerging markets, and in front of you there are two choices. The first is VWO, which is Vanguard's version of the emerging markets ETF, and then you have IEMG, which is iShares' version of emerging markets. So different ETF providers and then different index providers as well. But FTSE or FTSE defines emerging markets very differently than MSCI. In fact, if you looked at the underlying holdings, you'll realize that FTSE does not include South Korea within its definition of emerging markets. So if you really cared about owning South Korean stocks as part of your emerging markets ETF, you would have to pick IEMG because the MSCI version of the index includes South Korea inside. Whoa, you might be asking, this is a lot of info, and where do I find it all? Now, I personally invest mostly in US-based ETFs, and thank God there's a lot of free resources out there that helps you get that information at a glance very quickly. I personally use ETF.com and occasionally use ETFDB.com, which has a better analyst summary of what an ETF does. If I'm looking at European ETFs, I'll be using another site called justetf.com. And sometimes the information is not very updated, so occasionally I might actually go to the ETF's homepage itself to dig through the prospectus. And the reason why that all matters is that the more sophisticated you become as an investor using more specific strategies, that's where you really have to scrutinize the underlying holdings. Other strategies could be like thematic-based investing, and I recently covered that in another video where I talked about ARKX, where it is thematic investing in space. One of the cautions there is that if you had an idea of what space investing is like, it is likely to be quite different than how ARK Invest defines space, as well as two other ETFs which has space themes, which is UFO and ROKT. That's why if you were interested in investing in specific themes, you would want to scrutinize how does that ETF define that theme and what does it hold. Another great thing to look out for is to ensure that you don't have an unintentional overlap in the ETFs that you own. So for example, say you're bullish about the US and you bought the total US stock market through VTI. And then you're telling yourself, maybe I should diversify, and you choose to buy VT, which is the total world stock market. And if you didn't scrutinize the underlying holdings, you might not realize that VT actually holds 60% of its value in the US itself. So if you weren't aware of that and you didn't size your position right, you might end up with a huge overlap with VT and VTI, and this could be done unintentionally. Next is when you're comparing ETFs for costs and possibly tax efficiency. If you didn't already know, if you were investing from Singapore or Malaysia in US-based ETFs, you'll be incurring a 30% withholding tax on any income or dividends that you earn. Now, on a practical level, this simply means that we probably shouldn't be investing in more dividend type strategies when it comes to US-based stocks. At the second level, you'll need a broker that has access to the UK or German stock markets, which is where you'll find UCITS funds, which is a special class of ETF. These UCITS funds are not domiciled within US, and therefore they will have a tax efficiency where they are only charged 15% on the withholding tax. So that's half the amount of tax that you'll be able to save. One more consideration about costs is if you happen to see ETFs that end with a ACC or DIST. ACC simply means accumulating, and that's where the dividends are automatically used to buy more shares of the ETF. If you don't mind continuously growing your ownership of that ETF, it's actually a cost-effective thing to do. DIST stands for distributed, which simply means that any dividends that you get is automatically given out to you in cash. And this is great if you prefer to use that cash for any other reasons. Now, before I end, there's one final parting note. While I'm a fan of optimization opportunities, I think that if you're just starting out or if your account size is a little bit smaller, it's something that you shouldn't need to worry about too much. So don't let the fear of stumbling or making a mistake hold you back. Just start buying and accumulating, and over time you can optimize things. So today's one was a little technical, but I really hope you got some value out of this. And if you did, I would really appreciate your support in clicking that like, subscribe, as well as that bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.